The S&P 500 is one of the greatest investment products ever created. If you buy it, hold it, and give it enough time, you will probably do just fine. That is the honest part, but I have spent my life learning that in investing, fine and better are not the same thing. And when you stretch a small difference over a decade or over 3 decades, that gap stops looking small. It starts looking like a completely different life. Let me show you what I mean. Suppose you put $10,000 to work today and never add another penny. If that money compounds at 10% a year, which is roughly the long-run average people like to use for the S&P 500, then after 10 years you are sitting on about $26,000. That is respectable. But if you do only a little better and earn 13% a year, that same $10,000 grows to around $34,000. At 15%, it becomes roughly $40,000. At 17%, which is the kind of number people throw around when they talk about elite investors, that same $10,000 grows to nearly $48,000. A lot of people look at that and shrug. They say the difference between $26,000 and $48,000 over 10 years is interesting but not life-changing. That reaction usually comes from not carrying the math far enough, because 10 years is not how wealth works. Real wealth is built across decades. Now run the same example for 30 years. At 10%, that same $10,000 turns into roughly $174,000. At 13%, it turns into about $395,000. At 15%, it becomes around $662,000. At 17%, it gets close to $1.1 million. That is not a rounding error. That is not a cute spreadsheet exercise. That is the difference between ending up comfortable and ending up with real financial freedom. And remember, that example assumes you never add another dollar. If you keep investing every month or every quarter or every year, the spread gets even wider. The more time you have and the more disciplined your contributions are, the more a slight performance edge compounds into a very large outcome. That is the opportunity. Now, I want to be careful here, because this is where people make dumb mistakes. Anytime you reach for better returns, you are usually reaching for more risk. There are no magic returns floating around the market waiting for you to grab them with no trade-off attached. If somebody tells you that they are either selling something or they do not know what they are talking about, you are never guaranteed to make money when you invest. At some point, you will watch your account go down. At some point, you will feel stupid. At some point, you will be tempted to sell. That is part of the game. So the question is not whether you can find something that went up faster than the S&P 500 in the past. The question is whether you understand what you own, why it outperformed, what extra risk came with it, and whether you can live with that risk when the market finally turns against you. Before I get into the funds themselves, I want to make sure you understand the foundation. The S&P 500 is simply a basket of the 500 largest public companies in the United States. When you buy an ETF that tracks it, you are not buying a single company. You are buying small pieces of hundreds of companies all at once. Apple, Nvidia, Amazon, Tesla, McDonald's, Microsoft, a long list of large American businesses bundled together into one simple package. That is the beauty of an index fund. If one company falls apart, the index does not need your permission to adapt. If a company stops belonging among the 500 largest, it gets pushed out and something stronger eventually takes its place. You do not have to guess which one will stumble. You do not have to babysit the portfolio every day. You own the basket. And because you own the basket, you get broad exposure to the productive engine of the American economy. That is why the S&P 500 has been such a powerful default answer. Over a very long stretch of time, through recessions, crashes, wars, panic, booms, and every sort of stupidity markets can produce, that basket is still compounded at a remarkable rate. Not because it always goes up. It does not. Not because it gives you a smooth ride. It does not. It works because you are holding a collection of productive businesses, and because the country keeps producing new winners even when the old ones disappoint you. That is the baseline. So if you want to do a little better than the baseline, there are really 2 ways to try. You can become an active investor and try to figure out where money is moving before everybody else sees it. That can work. It can also destroy you if you are sloppy, emotional, or overconfident. Or you can stay inside the ETF world and tilt your portfolio toward slices of the market that have historically outrun the broad index. That second path is what I want to talk about here. The first place people usually go is toward growth. A growth focused S&P 500 ETF does something simple. It starts with the same broad universe of big American companies, but instead of owning all of them, it leans harder into the faster growing names and gives less weight to the slower value side of the index. In plain English, you are still inside the S&P 500 neighborhood, but you are walking past the slower, more mature businesses and putting more of your money behind the companies the market views as growth engines. Over the last decade, that kind of fund has roughly kept pace with or slightly outperformed the broad market, depending on the exact stretch you measure. Why? Because the last decade rewarded growth. It rewarded businesses that could scale quickly, reinvest aggressively, and command premium valuations. The trade-off is obvious. When fear shows up, growth usually gets hit harder. Slower, steadier companies can act like ballast in a storm. If you strip some of that ballast out, you may move faster in good years, but you also feel more pain when markets reprice optimism. That leads naturally to the second category, which is more concentrated. Still technology, a tech-heavy ETF like XLK narrows the field even further. Now you are not just inside the SP 500, you are inside the technology corner of it. Instead of owning 500 companies, you may own only 60 or 70 names. And most of the weight is going to be concentrated in the giant platforms and infrastructure businesses that have driven the market for years. That tilt has been extraordinary over the last decade. The returns have crushed the broad index, and there is nothing mysterious about why. Technology has eaten everything. It has changed commerce, communication, entertainment, cloud computing software, advertising, payments, data, and now artificial intelligence. If you believe that the digital backbone of the economy would become more valuable over time, then a tech ETF was one very simple way to express that belief. But concentration cuts both ways. The same reason technology can outperform is the same reason it can punish you. When optimism is high, it runs. When rates rise, sentiment changes, or earnings disappoint, it gets hit faster than the broad market. That is the price of the upside. The third category surprises some people because it has nothing to do with Silicon Valley. Defense and aerospace. A fund like PPA gives you exposure to businesses tied to military spending, aerospace systems, defense technology, and the machinery of geopolitics. These are the Lockheeds, the RTX names, the General Dynamics type businesses. And what makes this category interesting is that its demand does not always move with the consumer economy. A lot of businesses struggle when spending falls, but governments do not suddenly stop caring about defense because a recession showed up. In many cases, conflict, instability, and strategic competition make that spending more persistent, not less. That does not mean the sector is invincible. Nothing is. It means the earnings drivers are different. And when a sector's cash flows are driven by government priorities rather than whether households buy one more refrigerator, you get a different kind of resilience in the portfolio. Some people will not want to own that kind of exposure. That is a personal choice. A good investment has to make financial sense, legal sense, and moral sense to you. I am not going to make that decision for you. I will simply tell you that from a cold, practical investing perspective, defense has been one of the areas that has outperformed the broad market over the last 10 years. The fourth category is momentum. This one is more dangerous because it moves closer to the line between investing and systematic trading. A fund like SPEMO is built to own the strongest momentum names inside the SP 500. In simple language, it tries to ride the companies already moving up the fastest. The theory is that strength often persists for a while, so if you systematically concentrate on the strongest names, you may outperform, and historically on certain stretches it has. But momentum is not the same thing as buying quality and waiting patiently. Momentum can turn hard and fast. It can be wonderful in a strong tape and miserable when leadership rotates or the crowd rushes for the exits. You have to know that going in. If you buy momentum, you are not buying calm. You are buying a process that has worked historically, but one that can look extremely ugly when the market mood changes. That brings me to semiconductors, which is probably the cleanest modern example of a structural theme producing giant returns. A fund like SMH is focused on semiconductor businesses. These are the chip makers and the ecosystem around them. The reason this category has been so powerful is simple. Every major technological boom now runs through chips. Phones need chips, cars need chips, cloud infrastructure needs chips, defense systems need chips, medical devices need chips, and AI needs an absurd number of chips. If software is the brain people talk about, semiconductors are the physical substrate that makes the whole thing possible. That is why this space has been so explosive. When a category becomes essential to nearly every other category, the economics can get very attractive very fast. Over the last decade, semiconductor exposure has not just beaten the SP 500. In many stretches, it has demolished it. Now again, the warning matters. Past performance is not a promise. Some of the best performing sectors eventually become the most crowded, the most overowned, and the most dangerous when enthusiasm gets ahead of reality. That is why you never buy a fund simply because a 10-year chart looks beautiful. You buy it only if you understand what economic engine is underneath it and why you believe that engine still has room to run. The bonus category is the NASDAQ 100 through a fund like QQ. This one is broader than a pure tech fund, but not by much in practical terms. It owns the 100 largest non-financial companies listed on the NASDAQ. That means you are still leaning heavily toward technology, platform businesses, and large-scale growth. It has outperformed the SP 500 over long stretches. It has also been more volatile. That is the deal. When growth leadership is strong, QQ can look brilliant. When the market decides to punish expensive leadership, QQQ can fall faster than the broad index. So when people ask me whether a fund like QQQ is better than the SP 500, I tell them they are asking the wrong question. The real question is whether you understand the extra concentration and extra volatility you are agreeing to. If you do, and you can hold through it, it may be a sensible tool. If you cannot, then it will tempt you to sell at the worst moment. And that is where almost all the damage gets done, because the strategy matters more than the ticker. I have watched people buy fine assets at terrible moments and ruin the result by panicking. I have watched people own good funds, watch them decline 20%, 30% or more, and then dump them because they suddenly learned they were too risky. They did not learn the asset was too risky. They learned they never had a plan. That is why I keep coming back to the same discipline. Always be buying. If you own something you truly understand and want to own for the long run, then your default posture is to keep buying. When markets are calm, you buy. When politicians scream, you buy. When the weather changes, you buy. When the market is boring, you buy. When the market is euphoric, you buy. You do not build a long-term compounding machine by constantly waiting for emotional clarity. You build it by turning investing into a recurring behavior that does not depend on your mood. That is what I like about automatic investing. Money leaves your checking account on schedule and goes to work whether you feel bold that day or not. It does not care whether there is a Republican in the White House or a Democrat. It does not care what headline is trending. It does not care whether the market is green today or red today. That discipline is what protects you from yourself. Now there is a second layer to that strategy, and it matters just as much by the dip. Not because it sounds clever, not because it makes for good internet content. Because market declines are when your future returns improve. If you truly believe in the asset you own, then lower prices are not bad news for the dollars you have not invested yet. They are an opportunity in 2022. When the market fell, people ran. In 2020, when the market fell violently, people ran. In 2008, when the market was cut to pieces, people ran. And every time the people with cash, courage, and a working process were able to buy good businesses at better prices. That is not a fantasy. That is one of the obvious mechanisms in capitalism. The market periodically offers merchandise at a discount because human beings cannot regulate their emotions. If you can, you benefit. That does not mean you go all in every time the market drops 5%. It means you understand recessions and crashes are not rare accidents. They are part of the rhythm. We have had recessions, we have had crashes, we will have more of them. So instead of acting shocked every time it happens, you prepare for it. You keep some liquidity. You avoid overextending yourself. You do not spend every spare dollar pretending volatility was abolished. And when fear arrives, you use the environment to accelerate your wealth rather than destroy it. That is the difference between a financially mature investor and a tourist. A tourist buys when everything feels safe and sells when everything feels dangerous. A mature investor does the opposite. Now let me give you the entire picture cleanly. The S&P 500 is still a tremendous product. For most people, it is more than good enough. It is simple, durable, and historically hard to beat after fees and mistakes. But if you want to tilt for more upside, there are ways to do it. You can tilt toward growth. You can tilt toward technology. You can tilt toward defense and aerospace. You can tilt toward momentum. You can tilt toward semiconductors. You can use the NASDAQ 100 as a broader growth, heavy vehicle. All of those choices have historically outperformed the broad market over certain long periods. All of them also come with more concentration, more volatility, or both. That is why the real edge does not come from finding a flashy ticker. It comes from knowing what you own, why you own it, and how you will behave when the market finally punishes that category. If you own a tech fund, you better know it can get cut hard. If you own semiconductors, you better know enthusiasm can overshoot and then snap back. If you own momentum, you better know leadership can reverse violently. If you own defense, you better know political and regulatory winds can shift. There is no free lunch. There are only trade-offs. The advantage, if you have one, is that better long-term returns do not require some insane leap. You do not need to find a 200% moonshot. You do not need to double your money every year if you can improve your returns only a little and keep your discipline. The compounding will do more than most people believe. That is why I care about these differences. Not because I think every investor should dump the S&P 500 and chase sector funds. That would be foolish. I care because most people underestimate how powerful a modest edge becomes when it is paired with time. And most people overestimate how much brilliance is required to build wealth. The heavy lifting is not genius. The heavy lifting is patience. The heavy lifting is consistency. The heavy lifting is surviving your own emotions. If you want my plain view, it is this. Own good things. Know why you own them. Keep buying them. When they go on sale, buy more if your balance sheet allows it, and stop pretending the path to wealth is supposed to feel comfortable the whole way through. It is not. That is why so few people stay on it. But if you do stay on it, if you keep your head while others lose theirs, if you understand the difference between short-term volatility and long-term value, then a little edge can become a very large fortune. And that is the whole point. You do not need perfection. You need a sound process and enough time for the math to embarrass your doubts. Let me make the retirement implication concrete, because this is where the spreadsheet becomes personal. If two investors save with the same discipline, but one compounds only a little faster over a long stretch, the second investor does not merely end up with a larger account. He often ends up with more time, more room to step away from work a few years earlier, more room to say no to nonsense, more room to absorb mistakes without financial panic. That is the real dividend of a modest return advantage. It is not bragging rights, it is optionality. And optionality is one of the most valuable assets any investor can own. There is one more trap I want you to avoid. A lot of people hear a discussion like this and immediately start building a fantasy portfolio full of the hottest categories from the last 10 years. That is backward. You do not build a portfolio by staring into the rearview mirror and buying whatever already made the most people jealous. You build it by understanding which parts of the economy have real tailwinds, which vehicles give you exposure to those tailwinds, and how much volatility you can withstand without abandoning the plan. That last part matters most. A portfolio that looks brilliant on paper but makes you sell in a drawdown is not a good portfolio for you. It is a trap with a nice chart attached to it. A simple plan you can hold through fear will beat a brilliant plan you abandon halfway through. That is true in more areas of investing than people like to admit. So if you do decide to tilt beyond the broad index, keep your head. Do not confuse a stronger 10-year chart with certainty. Do not confuse concentration with intelligence. Do not assume what outperformed last decade must dominate the next one in the same way. And above all, do not let a temporary decline rewrite a sound long-term thesis. That is how people turn good ideas into bad outcomes. The market does not just test what you know, it tests what you can sit through. And usually the people who end up wealthy are not the ones who found the perfect ticker. They are the ones who found a sensible framework and then had the temperament to keep following it when it stopped feeling good. That is harder than it sounds. It is also where the real money is made.